Hello, welcome back. So, Target Corp has lost a lot of its value recently due to some woke incidents. They were selling some items in their stores that a lot of conservative people, and not only, didn't really like, and they faced some backlash. And so the stock actually went down quite significantly. So you can kind of see that in the last month over here, which you're already examining, you will see that the stock at some point was 160, and right now it's sitting at 126. And a lot of people, including myself, are wondering whether this is an opportunity, because I do understand that this what has been happening right now could keep going for a while. But as long as the company has a lot of value, as long as it's making good money, then it may be worth investing in for the long term again. Understandably, as I mentioned earlier, it could still go down, especially if they continue to do what they're doing against the consumers or a big part of their consumer base. Now, you will see the stock news page here in our tool, for which every patron has access, and you can become one by taking a look at myinvestorsheaven.com or visiting the link in the description box below this video if you're interested. You will see that targets should stay true to their values amid Pride backlash, so it was a Pride thing. This is the month of Pride, I believe. And ETFs to invest as consumers shift to economical shopping. This article is basically claiming that Target can be a value company for a potential recession, pretty much. And the Target boycott may be a really important case. So we have seen the Bud Light boycott, and now we are potentially looking at the Target boycott, and this could signal the potential of this stock going down a little bit. So this is why I wanted to make this video and talk a little bit about what is a potentially interesting entry point here, whether this is the one today or an upcoming one. So let's take a look at the metrics tab. And you will see that the P ratio of the company has been going lower recently because of the decline in the stock price, but not that much. It's still quite lucrative. Now, Target is a big company and it's a big retailer, and it's one that tons of people are using in the US. Target and Walmart are basically the biggest ones, and both are most often pretty much packed with people. Now, they are facing this backlash right now. They're definitely losing some customers, at least for a while. So it depends on how they're going to act to mitigate that stuff, what is going on right now. But we want to be taking a look at it and just be wary of what is happening, and whether we can actually gain some nice opportunities here from this stock price, or even lower potentially. Now, the price to free cash flow is also down. And the outstanding shares are down as well, which is nice because the company has been buying back shares recently, as the stock price was lower than what it used to be in the past 5 years. You can kind of see here, stock price was like more than double at some point. Now, this company, this stock is for the most part a stock that you want to be buying for a nice dividend, and you can kind of see here that their dividend yield is sitting at 3.4%. The payout ratio is sitting at 70%. Now the free cash flow ratio is negative, so the free cash flow is negative recently. But we kind of want to see what has been happening in the past, because this has been affected by some recent subpar results from Target. So we'll be examining the financials in a little bit more detail and see what is happening. But let's start with the dividend first. I want to take a look at the dividend. Of course, our tool here tells you about the dividend. You will see it here. And you will see that there was an abrupt increase in the dividend yield of the company back in 2021. And it's something that stockholders back then may have liked, but as a new stockholder, I'm not really that keen on, I'm not really that happy, I should say, to see it, and not that keen on investing when I see this kind of abrupt increase here, because it means that they are extracting more cash flow. And if the company's financials are actually lacking and they go worse than what they used to be, then this can actually signal something that could actually propel the stock backwards, could actually bring the stock down, the stock price down even more potentially. So I'm a little bit worried about this one. And let's take a little bit of a look at the actual model that I have here, the dividend discount Gordon growth model, pretty much, which will tell us if the dividend is enough today based on the stock price. So if the stock price is expensive compared to what the dividend is, pretty much. So let's take a look at this one. Now, as I mentioned, you will see the abrupt increase here. Year 4, year 5, 32%, 20%. Usually, it used to be like 3%. So for the dividend growth, I will go back to the old days. I do expect that at some point, maybe they will even cut down the dividend. They will even cut the dividend to a lower dividend than what they are paying right now. They're paying 108 per quarter. So if that happens, it could bring the stock down even more, the stock price. But I will just go with like 1%, 2%, and 3% for the dividend growth in the upcoming years. And again, I'm a little bit worried that they would eventually have to cut down on the dividends. Now, we can factor that in our calculations as well. Let's examine the annual return that we're going to be getting. So let's just say that we're going to be getting 7% out of the stock dividends pretty much. And you will see that with this kind of annual return, it is only with a dividend growth of 3% a year that we are sitting at 111, where the current stock price is at 126. So obviously you can actually ask for less, because you can make a case for the company stock price increasing more as it has dropped a lot. And in this case, when you are asking for less of an annual return, you're getting closer to the current price. So we're not that far here, but I do want to examine the financial statements before I dig a little bit deeper into the discounted cash flow model. Remember, the dividend growth model, the Gordon growth model, is important to factor for the dividends, but it doesn't tell you everything about the company, because if the stock price has been down like 50% and the company keeps going back to growth, you can actually see the company stock price increasing quite a lot and sort of becoming a little bit of a growth company as well, at least for a while. And so you cannot just use like 10% on the dividends and ask for that alone, because you're getting a stock price increase as well. So that's something to factor in your calculation. And this is why we ask for less of a dividend gain from the dividends pretty much model. And you will see that the revenue of the company has been increasing, yet their net income has been going down. They have been affected deeply by the pandemic. We have seen that lots of companies pretty much. And you can kind of see here in the cash flow statement as well, which is interesting, that starting from a net income of 2.7 billion in 2023, back in 2022 they had almost 7 here, and their operating cash flow is sitting at 4 over here, which is like 50% of what the previous year used to be. And this obviously affects the free cash flow here, taking it to negative territory, and this is why you were looking at a negative free cash flow to dividends pretty much ratio. And you will see that usually they make something like 5 to 6 to 7 billion in free cash flow, which is significantly better, obviously. And usually they make about 7 billion of net income, 5 to 7 billion of net income. So it's almost, about the same, pretty much, net income to free cash flow, a little bit less usually, as expected. So the company is usually doing much better than what they are doing right now is the case pretty much. And so we have to factor this in our discounted cash flow model. We have to think about it. And the revenue growth of the company recently has been a little bit higher because they're coming off of some worse years. And right now they're sitting at 3% last year. I'm going to go low because I want to be a little bit careful here. I will go 3, 4, and 5. And net income margins, this is a problem for a company of this sort. Their margins are usually low, and you will see it pretty much every year. About 4% is what they're doing. I will go 4, 5, and 6. And the free cash flow margins that I'm going to use, something typical, 80, 90, and 100, with an annual return of 13% is the one that I typically ask for. And I hit calculate. And you will see that with this kind of growth, which obviously really affects the company, because a revenue growth of this sort for the company that's making 110 billion is significant. It's like a significant difference between these kinds of revenue growth here, and can actually significantly propel the max price to pay over here, especially when the margins are increasing. And the margins are also super important because they lead to higher profitability and obviously a potential even higher price to pay. So this is why it's important to try different case scenarios here and see which ones adhere to what you believe the company will be doing. And frankly speaking, I think maybe the 6 one is a little bit too much here, because the net margins have been a little bit lower. So maybe I went a little bit too overboard with this one. Maybe try 3.5 and 4 actually. This seems to be adhering more to what the company has been doing in the past few years. And we can kind of see that the 5-year average margins have been 4.3%. So yeah, 6 was a little bit too much. Let's try this one. And for this, yeah, we're sitting to something that makes more sense in my eyes. And the medium one is 117, the higher 156, and the low at 86. And I do think that it may be worthwhile waiting a little bit here. So 126 right now, it may look like an interesting opportunity, especially if the company goes back to its usual But based on what is happening right now, based on all the backlash, based on the potential boycott continuing for the company, I could definitely see this company going down more. So I don't think I will be entering here. I think I will be waiting for it to potentially go near 100 even. I don't think that's unlikely, actually, even though it has dropped quite significantly. I don't think it's unlikely at all, based on what is happening right now, because the sentiment is very negative. So I wouldn't really want to enter potentially right now. And I'm not so much about the sentiment, but it's not like this is a fantastic opportunity either. So it's not like we're gonna miss on anything. Now, if it goes $100 or less, then maybe it becomes a much more interesting opportunity, because then you get an effectively higher yield here. And I'm not so much worried about the ratios here, because again, they will be fixed in the upcoming quarters and years. But I feel that 127, even though it's down from what it used to be, it's still more expensive than I would like to pay. And again, I would be looking at these levels. Like if it goes to these levels, down to these levels, then I would be potentially more interested. Do let me know what you think, guys, about Target. Actually, I'm curious. Are you into this one? Are you thinking of finding it right now amid the backlash? What do you think about the company? Leave a comment below. I'd love to hear your opinions. And thanks for letting me know. Bye-bye.